Hello everyone, my name is Taranpreet Kaur and I am a student of BCom Financial Services Semester 5 of Hans Raj Mahila Mahavidyalaya Jalandhar. Before I start my seminar, I would like to thank our teacher in charge Mrs. Savita Mahendru for their special guidance. So today I am here to give my seminar on the topic Systematic Investment Plan. So here are the contents: introduction to mutual funds, types of mutual fund, systematic investment plan, its types, features, how does it works, benefits, limitations, SIP plans, SWOT analysis and conclusion. Let's start with the introduction of mutual funds. Mutual fund is an investment vehicle where investors pool their money to get higher returns on their capital over a period of time. The corpus of fund investment is are the professional known by fund manager and management portfolio. Types of mutual funds are further divided into three categories on the basis of asset class. Debt. Debt is also known as fixed income. These are invest in assets like government securities and corporate bonds, etc. Equity. Equity is invest your money in stock, and these are high degree of risk. Third is hybrid funds. Hybrid funds are include both equity as well as debt funds for your investment. On the basis of structure. Open end mutual funds. These are highly liquid because these redeem at any time on a business day. Closed end mutual funds. These are less liquid funds. On the basis of investment, there are growth funds, income fund, liquid fund, tax saving funds, etc. Now, what is systematic investment plan? Basically, SIP is a financial planning tool which help you to create wealth by investing small sum of money every month over a period of time. For example, you can start your investment monthly or weekly or daily basis with rupees 100 only. So now the types of SIP. First is flexible systematic plan. It lets the investors to modify the investment amount as per the financial conditions and the market circumstances. Second is setup systematic investment plan. It also known as the top-up SIP. It permits the investors to upgrade the amount of investment in SIP at fixed amount of time. Third is perpetual SIP. This kind of investment applies to all range of investors. The SIP requires the investors to enter the start and the end date of the SIP. Fourth is trigger SIP. It implies trigger option is available with the investor for their SIP investment. So here the features of SIP. The investor can choose different time period, for example daily, weekly and monthly, and there is no need to issue payment every month. And a investor can start with the low amount, that is 100, and there is available multiple SIPs, and it is very flexible that customer can choose with their own convenience, and they invest in equity and debt also. The minimum period of SIP is usually for 6 months, and the dates are invested in SIP is 1st, 7th, 10th, 15th and 20th of the month, and there is no lock-in period. A person can redeem at any time. So now there are some risk factors of a SIP are: first is market risk. At times the price or yield of all the securities in a particular market rise or fall due to abroad outside influence. Second is inflation risk, sometimes referred to as a loss of purchasing power whenever inflation rises forward faster than the earnings of your investment. Third is interest rate risk. Changing interest rate affects both equity and bonds in many ways. Investors remind that predicting when way rates will go rarely successful. Fourth is exchange risk. A number of companies generate revenues in foreign currencies and may have investment or expenses also denominated in foreign currencies. How does SIP works? SIP is a method of investing a fixed sum regularly in a mutual fund scheme. SIP allows one to buy units on a given date each month so that one can implement a saving plan for themselves. Power of compounding. Power of compounding works best as you stay invested, helping your money earn money over the years. How to invest in SIP? So first of all, understand your risk and what is your objective of investment. Second, choose a good mutual funds for your investment. And after that, select the date of SIP, in which date of a month you invest in your SIP. And fourth, decide the duration of SIP. It may be of any time, any duration, maybe 2 years, 3 years. It's according to your convenience. And after that, stay invested till the end of your investment period. Nowadays, we can see that digital media has a big platform. All the works are done online. So, how to invest in SIP online? You can also invest your SIP online also. There are some steps. First is keep the necessary documents handy. Second, get your KYC done, and after that start your SIP online. There are most SIP plans available in the market, but the best SIP plans are, for example, LIC SIP Investment, UTI, Axis Bank, Reliance SIP plans, ICICI SIP plans, SBI SIP Investments, etc. So here are the benefits of SIP investment plan. First is higher returns. As compared to traditional fixed deposits, SIP provide double the returns. This can help you beat the rising cost because of inflation. Second is convenience. It is flexible mode. You may not have extensive market research and analysis to adjust or balance your portfolio. Third is simplicity of choice. With SIP, you can start investing small amounts and watch it grow big. Power of compounding occurs when the returns you earn on your investment start earning returns. Low initial investment. You can invest in mutual fund through SIP with just rupees 500 per month. Act as an emergency fund. You can withdraw your SIP at any time when in any emergency situations. It is easily affordable, and it converts your habit into savings and rupee cost averaging. Now, the limitations of a SIP. Limited options of dates. For a SIP mutual fund, you need to decide to date in advance when you like to do your SIP and give your ECS mandate for the same. Second is fixed amount. There are times when you feel that markets are under devalued and you want to invest more, but in SIP you only predetermined fixed sum get invested. Third, stopping immediate payment. It may so happen that you got an emergency or have a major expense for this month and you don't want to invest. But SIP, it is possible. If there is money in your bank account, it will get debited and invested in SIP already. Lot of delay between the actual application start and stop of SIP. I feel this is very irritating and you may miss one monthly installment. Next is does not suit people with unpredictable cash flow. Think of someone who does not have a predictable cash flows and like a self-employed professional. So it may be very difficult for that people. So now the SWOT analysis of the SIP. Let's start with the strength. One can invest very small amount per month. SIP reduces the average cost. It helps to avail power of compounding. SIP avoids the pitfall of the market conditions. SIP helps to accumulate wealth in a disciplined manner by rupee cost averaging. Now, the weakness of the SIP. Companies charge entry and exit fee. Same amount of money is to be invested at the regular intervals over a period of specified time span. Now, the opportunity of the SIP. The emphasis on averaging out in an SIP makes it more useful in case of an equity fund. As the volatility is greater, a SIP can be useful for a debt fund as well as build a pool of savings. So now the threats of the SIP. Rate of return is not fixed. Many local and global factors affect share prices, and if they are negative, there may be a big impact. So now, conclusion. It can conclude that SIP is a monthly based investment plan through which an investor can invest a fixed amount into mutual funds every month at pre-assigned dates. This protects the investor from market volatility and derives maximum benefit as the investor is done at regular basis irrespective of market conditions. SIP is the winning strategy is present market scenario.